to computer. And there we go. Hey, Neil.
Hey, Barry, how are you?
You're looking great with a nice fresh haircut.
Yeah.
Me a little bit too. So
Yeah.
the quarantine was probably getting the better of both of us.
I know. Oh God, it was so bad before this. I finally just couldn't. I took the risk. I went in a bubble, and the lady, basically cut my hair. So
It looks good. Looks good.
thank you.
Thank you for. Oh, you've frozen a second. There we go. Thank you for agreeing to do this. I know you've got a lot going on right now, a lot. But I appreciate you taking the time. So for those who don't know, do you want to tell people a little bit about your background and what you've got going on?
Sure. I am a defense contractor by trade. I work for an Air Force contractor in Las Vegas, Nevada. I've been in doing real estate technically since about 6 years ago. My wife and I sort of fell into doing a short-term rental out of the front of our primary residence. It was a fantastic house hack that sort of got me into, gave me the idea of real estate, sort of like finally kind of got it. And we've been digging into real estate now for about 3 years. We have 2 BRRRR properties under our belt in North Carolina. And we're in the process of getting a self-storage, some self-storage deals off the ground. We'll see. And then I'm also the co-host of the Road to Family Freedom podcast with my lovely wife.
Yeah, and what a great podcast it is. You do a fantastic job. I listen to your podcast a lot, so it's really good. So that's interesting that you talked about that. It was the Airbnb that kind of got you interested in the casita, right? I believe, or a mother-in-law suite, whatever technically is, and that. So you guys knew nothing about real estate investing before that. You just saw that you had this empty casita, or you did. How did that come about? How did you decide to sort of venture into that?
So there's more to the story.
Okay.
It's a sad story.
Okay.
My first foray into being a real estate investor was buying a condo. It was my first property that I was going to live in February of 2005 in Las Vegas, Nevada. It was a 1-year-old condo, beautiful area. It had doubled in value in a year. More than doubled in value. The guy that I bought it from was getting a divorce. He'd bought it for $100,000. I bought it for $205, 12 months later. First warning bell. I should have gone off. Unfortunately, it didn't. I purchased it with, I think, about 10% down on a 5/1 ARM. Moved in. Life was good. The value went all the way up to, I think, 275 at one point. And then I think at one point it was down. Of course, the crash happened. And I think at one point it was down as low as 55. And then I short sold it in September of 2014 for 100,000. And we had moved out. We moved into our house that we have lived in for the last 8 years in June of 2012 when we started renting that condo out at a loss. It was probably, I think, our mortgage, we were all in for probably $1,400 a month, and we were renting it for $850 a month. So do the math there. It was
that's rough.
It was pretty ugly. Which was fine. We were kind of just holding on to it, hoping it. We kind of knew it was never going to come back. I didn't want to let it go because I have a security clearance, and at the time, it's a derogatory mark on your security clearance. So a lot of people, you don't want to default on mortgages, credit cards, and things like that. Well, it finally got to the point where the security services just had to sort of ease up a little bit, and they basically approved my short sale. And we wouldn't have even short sold it except we had this triple whammy of my pregnant wife, who was 6 months pregnant at the time, lost her job unexpectedly. We had the tenant who was 6 months into a 2-year lease, but they were military. They got PCS, which means a permanent change of station, and they can break the lease without any penalty. So they moved out. And then we had one other sort of financial setback, and it was just like, all right, we got to stop. So that was my first entry into landlord, and basically having a quote unquote income property, but it was taking almost $650 a month out of my pocket when it was occupied.
Wow.
So,
That's quite the introduction to real estate, huh?
yeah, yeah. And then meanwhile, my dad was a frustrated landlord back in the 80s, and always hated it. I mean, he just, he hated being a landlord. They bought the property, I think, back when the tax laws were different. He and my mom were high enough income earners that they could shelter their income with the rental property. And that's why they did it. And then the laws changed. And so you could only basically shelter whatever income you were making from the rental property. And so he hated it. He always told me, real estate investing, I don't want to be a landlord, blah, blah, blah. So,
so it's a surprise that you ventured in at all after that, I guess.
yeah. I mean, he later on, he's passed away recently, but he, in the last probably year or so, I got him into a couple of investments, and he was like, you had a good feeling about that. That worked out really, really well. Thanks for getting me involved in that. So,
okay. That's nice.
But I'm not sure did I answer your question?
Yeah, well, it was kind of, I was asking how did you get it? What opened your eyes to the Airbnb? What made you sort of think, okay, this is.
We fell into that too. We bought that house, and it had a mother-in-law unit, also called a casita or a guest house, or what do you want to call it, at the front of the house. And this was, we bought it in June of 2012, moved in, and I originally was going to make the guest house my man cave, and that lasted for about 48 hours, maybe, probably less than that. And my wife ended up turning it into a very nice, just visitors' quarters, primarily for my in-laws to come and visit. They live out of town, so it had had a TV, a little mini fridge, a microwave, a coffee bar, and it was basically appointed like a very nice little hotel room, and never considered renting it out. And then in December of 2012, my mom sent me this article about this company called Airbnb, and she said people are renting out their spare rooms and making a little extra money. And I was like, all right, okay, so we took some pictures of it, and we listed it on Airbnb, and within 2 months we were making almost $1,500 a month gross on it, which was more than our mortgage.
Yeah.
So it was paying our mortgage, all of our expenses. So, and we continued to do that for 7 years, right up until the end of February of this last year, which I can go into if you want.
If you want, I know what happened, but I guess
Yeah.
you might as well share. Yeah, I think.
Well, it was a double whammy. One was we're in Las Vegas, and COVID hit, so everyone and their mother canceled all their reservations, which was fine. We expected that. And then also the city, first our HOA sent us a nasty note, and they had changed the rules because when we started, nobody knew about Airbnb. It was an unknown. Nobody, few people were doing it. Well, now everybody's doing it. And the HOA caught wind of it, and they changed the rules, and they finally caught wind that we were doing it. And they sent us a cease and desist. And then a month later, we got one not a month later, a week later, we got one from the county as well, which told us to cease and desist. So it was fortuitous timing, and that COVID happened, because we would have been shut down anyway. But it was a nice run. We had it for 7 years. It paid our mortgage. It allowed us to pay down our equity. I mean, it paid down our loan in a huge way. And now we have sold that house as of 1 hour ago today.
Yeah, congratulations on that.
Thank you. Thank you.
Yeah. Well, first and foremost, the Airbnb you always spoke about, I was very jealous because that's a phenomenal deal that you guys, and I think you guys had managed to outsource most of the work by the end as well anyway. So it was quite hands off by the end anyway. And it was just bringing in this great cash flow, which just shows you that the power of real estate again, and power of, using different strategies and understanding what's available to you and making it work. I don't know if everyone's heard of a house hack before, but it's basically where you somehow engineer it so that you're not paying much of your mortgage, or if any at all, be it renting out a room, renting out a casita, renting out many rooms. We know a few people that do that as well. So
it's anybody, I don't know why more people don't do it. I mean, it's we were in a unique situation because the unit was completely detached and had its own separate entrance from our home. But I have family in very high cost of living markets who are still renting. And I ask them, I'm like, look, why don't you try and find a duplex, triplex, or fourplex? It's probably going to cost you a little more, and it maybe not be in the greatest area, but you can live in one unit and rent out the other units, and you're probably going to live rent-free, mortgage-free, and you're going to build equity.
Yeah.
We've interviewed people on our podcast that live literally blocks from the beach in a duplex for free because they rent it out as a short-term rental. They rent out one side of it as a short-term rental, and it pays their mortgage plus income.
Yeah. Yeah, it's amazing. When I heard it for the first time, I was blown away about the house hack and its possibilities. So, yeah. So you recently sold your house. I don't know if you feel comfortable talking about that, but
sure. Now that we've recorded, I feel comfortable talking about it.
Yeah. Was there a strategic reason behind that?
Yes. I'm not an economist.
Yeah.
But and part of this may have been some post-traumatic stress from going through the Great Recession here in Las Vegas. But I woke up probably the end of April of this year on one Thursday morning in a bit of a panic because I realized that no matter what was going to happen with as far as the stay-at-home orders with all the different state governments, that Las Vegas was probably going to be in trouble for a little while. I think we've hit 32% unemployment is the last I heard statewide, which is the highest in the nation. And even if all the restrictions are removed, I know shows are canceled. There's no conventions. All the conventions have canceled. The casinos that are open are operating at minimal capacity. There's no nightclubs. And, Vegas is very much a tourism-based economy. And tourists have certainly come back, but not nearly in the way that they were coming. And I think Vegas will be fine long-term. I think that, I'm an optimist. I think we'll get our handle on the COVID pandemic eventually, but I don't think it's going to be as fast as people think it's going to be. And I think the recovery could be a while in Las Vegas. Now, housing isn't always affected by recessions, but I didn't want to take the chance that the home prices were going to go down significantly. I wanted to have options. We had a substantial amount of equity in the home, and I wanted to grab that equity and then hit the reset button and wait and see what happens. Now, maybe we'll maybe it's going to continue going back up. I'm okay with that.
Yeah.
I wanted to be, if I was going to err, I want to err on the side of being wrong in the up direction, not the down direction.
Yeah. Well, I told you, I couldn't agree more with what you've done. I kind of did the same about a year ago. I sold 2 of my properties here because I knew what I had in equity I didn't know what was going to happen next, and that was over a year ago. So it might have gone up, but it might well have gone down. And I was happy with the amount that I had at the time when I was selling. I think it was the same case for you.
Yeah, don't be greedy.
Yeah, that's exactly what it is. If you've made a good amount of money and you can take advantage of that, I think it's smart to do that. And the great thing with you as well is that you lived there more than 2 years, so the capital gains tax doesn't apply to you, so you're able to.
Not quite.
Oh, okay.
Right. So
Okay.
so I would have thought the exact same thing. Problem was that it was also an income property.
Okay.
And we took depreciate every year that we were earning income on that. We took depreciation on the property because it was technically an income property. So we did have to do some depreciation recapture,
Mm-hmm.
and I owed $17 this year.
Oh, okay.
So
You can live with that, I think.
I can live with that.
It's not going to break the bank. Yeah. So cool. Well, congratulations on selling the house. Congratulations on the success of the Airbnb, and thank you for sharing that. I'm sure it was a very traumatic time going through that with your condo. Thank you for sharing that, because I think it's always nice to hear. Not nice. Sorry, that's the wrong phrase. It's always educational to hear people's mistakes and how they've learned and experiences, because someone else might go through something similar.
Yeah.
So moving onwards now to you mentioned it, 2 BRRRR properties.
Correct.
For anyone who doesn't know, it means buy, renovate, rent, repeat. Did I miss something? No, refinance.
Refinance.
Yeah. So it's basically a process where you buy a property with some work that needs to be done, you fix it up, and then you're able to refinance and pretty much pull out all your money from that, and then still cash flow some. So you end up with no money in the deal.
Correct. Or as little money as the deal as possible.
Yeah, exactly. So do you want to talk about the first one? The first
Sure.
one you did? And
Sure.
where you bought it, bearing in mind we're in Las Vegas, Nevada, and why you decided that?
We bought it in North Carolina, Fayetteville, North Carolina,
Mm-hmm.
and it was a little 3-2. God, I don't have the exact square footage for you,
Okay.
but it was, and we bought it for 60, and we put about 25,000 into it, and it appraised for 117,000 after we rehabbed it, and then we were able to refinance it. And if you'll give me a minute, I'll look up the exact numbers.
Okay. Yeah, absolutely.
Stand by.
Okay.
I should have had these up.
No. We didn't know where we were gonna go today, so. And you found this deal on the MLS?
I did, actually. Yeah, I have a good friend of ours, a mutual friend of ours, has a great team on the ground in Fayetteville. Otherwise, I would not have really been all that comfortable doing a long distance deal like this.
Mm-hmm.
And he's got an agent who's investor friendly, which is very important. You can't just go to any old real estate agent.
Yeah.
So I wouldn't recommend it.
Yeah, especially for something like a BRRRR where it's the purchase price and the refinance price is critical for getting all your money out.
Yeah, I mean, they've just got to understand the process. I mean, a lot of real estate agents just don't think like that.
Yeah.
I mean, you would be amazed at the number of people in real estate who have no idea how investing works. And if you told them that you could buy a property for, half of what it's going to be worth after the rehab, they'd say, no, that's impossible. You can't do that.
Mm-hmm. Yeah.
Because they just don't think like that.
And I think, and they would say the same, that there's no way that you can get a deal where you pull all your money out and that you'd still cash flow and you'd have no money in the deal or very little money in the deal.
Yeah.
So it's, I think that's important for people to know, people who are just maybe starting out. Don't let other people's limiting beliefs deter you from, doing what you believe you can do, because there's plenty of proof of concept that you have two properties that you're able to do it with. And there's, if you go on Bigger Pockets or online anywhere on Facebook or what, in these groups, there's plenty of people doing these things, so don't let someone tell you you can't.
Yeah.
Because
okay. So on that first one, we were all in for $81,000.
Okay.
I take that back, $85,000. It appraised for 117, and we were able to get a loan long term, and we were using funds from our HELOC on our primary residence at the time. And so we were all in for about $85,000. And then we were able to pull back, we were able to refinance and get about $80,000. So
Okay.
we have about $5,000 still in the deal.
Yeah.
But we've now got over $30,000 in equity in that property. And it cash flows about $250 a month.
Right. So all in all, a fantastic deal.
Yeah.
I
wouldn't say fantastic. It's a base hit.
Okay.
It's a base hit. I mean, there are people, yeah, it's a base hit deal. It rents for $950. And
it's more than well beyond the 1% rule then, if you're all in for 85.
Correct.
Yeah. I think there's a few interesting points here. One was that you were able to piggyback on someone else's team and their experience, but that comes through building relationships. You have a relationship through Alex, and without that and building, getting to know him on a personal level, you never be able to do this deal. And it goes again to show the power of a team. If you're able to put a team together or somehow get a team, you can make so much more progress. Like you said, there's no way you'd be able to, I don't think so anyway, manage a rehab, manage the property, find the, it's too much of an ask really. So it's great that you were able to do that. And I think anyone listening who wants to do it is concentrate on the team first, more than anything else.
Absolutely. The deals will come, start with the team. And I would say your first, if you're going to invest long distance, David Green's got a great book on long distance real estate investing. And I can't remember what order he recommends it, but I mean, you're going to start with a real estate agent in the local area that knows the local market. You're going to look for a property manager, and you're going to look for a contractor. And don't ask other real estate investors for who their contractors are, because they're not going to give you their good guy. If they've got a really good guy, they are keeping him employed enough that he doesn't have time to do anybody else because they don't want him to leave. And I think really the secret sauce to investing long distance really is the contractor. I mean, you and I both know you've dealt with it yourself, and we've had some good friends that have been in some deals that should have been great deals, and they were made nightmares by not even really bad contractors, just kind of not great contractors. And so a contractor will really make or break your deal, especially if you're doing it long distance.
So true. I think that's the hardest piece of the puzzle to find, because you never really know truly until you get in there. Okay, you can ask around for referrals, but sometimes, as you pointed out, that's not, or if you're asking other investors, or I speaking personally, I was referred to by some other people who had nothing to lose if that person wasn't good, so I think that's something else that, if someone, our good friend Alex again talks about skin in the game, right? If they have some sort of skin in the game for referring that person, be it that socially they'll have a bad reputation for, or if they're trying to help you in other ways. So if you're able to have someone that has something to lose by referring to them, if that makes sense, I think that can help you find someone as well.
Yeah, I mean, you can go. A lot of times, people recommend going to a property manager and asking who they recommend as a contractor, but you got to be careful there, because sometimes there's, you might have a situation where they're getting some kickbacks.
Yeah.
So but that would be somebody who would have some skin in the game. If there's somebody who's going to be your eventual property manager and they've got a contractor, who's going to do a bad job for you, it's going to make them look bad.
Yeah, absolutely. Absolutely. So was there any headaches? Was it plain sailing on that first one, or was there any hiccups?
For the most part, the biggest, we were over budgeted on the rehab. We estimated 20 on the rehab, and we ended up at 25 because a chimney we had to rebuild the chimney unexpectedly.
Mm-hmm.
So my contractor, who's actually really good, he missed it. He just missed it.
Yeah. I think that's another reason why it's good to be well capitalized with these deals, that you're not right at the margins, that you at least have some wiggle room. And as you just mentioned, that you never know what, even the best contractors can simply miss something just
Yep.
by pure bad luck or whatnot. And it's important to have some kind of extra money laying around that you can take care of these kind of things. So then you rolled into your second deal, your second BRRRR.
Yes.
Which I believe is still going on, or are you out sort of?
Almost done. I mean, it was COVID threw a monkey wrench into everything.
Mm-hmm.
We purchased it in February of this year, started the rehab. We purchased it for 60, and we budgeted 35 for the rehab.
Mm-hmm.
Actually, no. God, it's amazing how the numbers I'm sorry. We were in it for 65.
Okay.
And we had 35. We budgeted 35 for the rehab. And then we finished the rehab at the end of April. And then COVID hit.
Right.
And we would have normally been lining up to do the refi on that. And I got a call from my mortgage broker, who's also great. He's a great member of my team. He calls me and says, hey, the lender that we work with is shutting off cash out refis nationwide tomorrow at midnight, or by close of business. Pardon me. He said, so we need to get your rate locked in today. And so I had to jump through a ton of hoops and try and give them all of the documents that they needed to do the refi. Now, normally, if you're going to do a cash out refi on a rental property, most banks, if it's through a Fannie or Freddie bank loan program, they will require you to have some seasoning. It's usually 6 months to 12 months of rental income. So you have to have a tenant in place for 6 to 12 months. It depends on the bank. I have been using a program called delayed financing, which is also a Fannie Mae Freddie Mac program, but it essentially allows you to do a cash out refi immediately with no seasoning in place. And it's basically 75%, it's normally 75% LTV. And it is whatever is on the HUD or 75% LTV, whichever is lower.
Mm-hmm.
And so what you do is you put your rehab costs onto the HUD when you purchase the property.
Okay. And
so then basically what the lender will do is give you back the money that's on the HUD.
Okay.
And that's the way you do it. But the problem you sometimes run into is that, like on the first one, we went over budget. And so we were not able to take we were only able to take out what was on the HUD.
Mm-hmm.
So on this one, we went higher. We actually overestimated the rehab costs, and that actually came out in our favor. I actually got $1,800 back from the contractor.
Okay.
But because of COVID and because of tightening lending standards, especially on cash out refi, we're only able to do 70% LTV. So we're going to end up leaving probably $10,000 in the deal.
Right.
We were our rate lock was supposed to end today. But they they keep asking me for underwriting keeps asking me for documents. If anybody's ever gone through underwriting on a rental property, it's like getting a tax audit.
Yeah.
And they're constantly asking for, what was this big deposit? We need proof of where those funds came from. We need a W-2, we need a bank statement and blah, just everything.
Yeah.
And so they've been asking me for those. And that was most of what I did today. Was I had about 10 documents that I had to get to them. And then luckily they've actually given us an extension to the middle of July.
Okay.
So we still have not finished the refi on that.
Yeah.
But when we do, all of that money will now, rather than on the previous one, all that money did was basically pay off our HELOC. Actually not all of our HELOC, because we still owed some money on it. But now, because we've sold our house, the HELOC's paid off. So all those funds will come directly to us. And
okay. So that's nice. So you're not paying anything in terms of an interest rate or whatnot.
Correct. And even then the interest, I had $175,000 out on my HELOC, and my interest only payments were $800 a month.
Wow.
Which I could handle.
Yeah.
And that's one of the, if you can do a HELOC, it's a great tool. Just keep in mind it's short-term debt. You don't want that long-term.
Yeah, I think HELOCs lend themselves perfectly to the BRRRR strategy, because I know a lot of people, they use hard money to do the BRRRR strategy. So hard money is, from a private lender or from a company where they're not like an institutional bank maybe, and their interest rates are much higher. You're talking 10 to 12 to sometimes 15%, along with a percentage of the total loan amount up front at the start of the loan. So it gets really expensive. Now, if you have a good enough deal, it makes sense, and you can get all that money back. But with a HELOC, you're paying what, a 5.5%, maybe 6% interest rate.
6%.
Yeah, which is maybe half what a hard money loan is, and you're replenishing that money at the end of the deal when you hopefully pull out most of your money as well. So it's you're almost creating equity from thin air in a way. You have equity in your house, but it's not real money until you sell it, and then you're able to use that to buy other properties. It's amazing, really. And again, like we mentioned earlier, I think if you start talking to maybe normal people on the street, or people with a limited mindset, limiting beliefs, they wouldn't believe that this is absolutely possible. But here you are, you have 2 properties that you used your HELOC to buy. It's great, and it's great to see you being so successful.
Yeah, and well, this one appraised. We were hoping it would appraise for 135, and it actually appraised for 137.
Okay.
So, we're all in for about 103,000.
Okay.
And so we just created, basically in the last, let's see, first one was October. So in the last 10 months, we have created $60,000, over $60,000 in equity. And we now have two properties that are cash flowing about $500 a month, all told.
Yeah.
Off of, we've probably got all told about $15,000 into the deal between the 2 of them.
Right. Yeah. Not bad at all.
Yep. That's the power of BRRRR.
Yeah.
It's also, it's also just value add. That's really what it is. I mean, you're just a value add investor. You're adding value as you buy it.
Yeah, and forcing that appreciation rather than just relying on the market to bring you up.
Exactly.
And I think, depending on where people are, I think it might be interesting, because when you told me the purchase price before, and then I asked you about the square footage, I was amazed by how big it was. I was expecting maybe 1,200 square foot. How big is this property that you were all for 103,000?
Yeah, let me see. Look. It's 19, it's 1 foot under 2,000 square feet. It's 1,999 square feet. It's 2-story. It's renting for $1,100 a month. My tenant has actually paid 10 months in advance.
Yeah.
Which is just bonkers to me, but
to me too, but yeah, it works out for you.
Yep.
So you've done a few deals now, and you've got your feet wet. What's next? Because from knowing you personally, I know that self-storage is something that you're really interested in.
Yes.
Um, is that something you're looking to venture in next?
Yeah, we have a partner, a good friend in North Carolina as well. Seems all my investing happens in North Carolina. It's a great state. If you've never been, I suggest you go. It's a beautiful state. Um, and he's a very experienced self-storage investor. He's got 4 properties. He's built one from the ground up. He has done a warehouse conversion from the ground up, where he converted an old abandoned paper mill into a indoor self-storage 2-story. He's purchased one that was also a conversion, has room to expand, and then he just recently bought his 4th, which also has room to expand. And so he and I have been dancing around for years, trying to find a way to help each other. And so I told him that I'm going to help him get to 100 million in assets under management, and we're looking hard for self-storage, value add self-storage in the North Carolina and South Carolina markets.
Okay, so you're looking to scale up quite a bit now.
Correct.
Yeah. And then for people again who might not understand the self-storage, they understand what self-storage is, but why it's such a great investment. Something I'm aware of, and I think you highlighted that to me. Why do you like that asset class so much?
Well, it's recession resistant. I hear a lot of people say it's recession proof, and I don't think that's true at all. It's if you think about the way that consumers use self storage, when times are good, they buy too much stuff, and they keep it in storage. They have toys and things like that they keep in storage. And then when times are bad, they downsize and they keep stuff in storage. And so it also, when you're looking at commercial real estate asset class, which I like because it's it's an income-based valuation. Ordinarily with residential real estate, you're looking at what's called a comparative market analysis to come up with the value of a property. And that comes down to what people paid for other properties in other areas. Self-storage is a commercial asset, and it's an income-based valuation. You've got the gross revenues minus the expenses divided by what's called a capitalization rate, and that gives you the value. And there's nothing, there's no wiggle room there. I mean, there's a little wiggle room, but not really. It's nothing like residential real estate. It also has a comparatively low expense ratio to something like residential real estate, especially like large multifamily. The average large multifamily is going to have about 50 to 55% of its gross revenue goes out to expenses, not including the debt service, the payment on the mortgage. With self-storage, it's more like 30 to 40%. It's with the one caveat. Here's the thing with self-storage that people need to remember is it is more a business than it is real estate.
Mm-hmm.
And so you really need to approach it like it's a business. There's a lot of opportunity out there because of that. There's a lot of, I think only the big operators, I think it's self-storage, own something like 20 to 30% of all the self-storage facilities in the country. And the rest are all owned by what are called, they're mom and pops.
Mm-hmm.
And we just interviewed a self-storage investor today on our show who bought a facility that was 65% economically occupied, meaning that, it may have been 85% physically occupied. There was actually, if there are 100 units, there was 85 occupied units, but economic occupancy means the amount of actual revenue that they were collecting of what they should be collecting.
Mm-hmm.
So that means that they had people who were not paying. They had people who were paying under rents, things like that. And then the way they were keeping records was literally on a written ledger. And she said it was literally, it looked like a written ledger from the 17th century because it was in this very nice, beautiful script.
Okay.
And that's great. You know, you got this mom and pop. That's how they've done things. That's how they're comfortable doing it. But tenants have to pay by, they've got to pay by check or cash.
Mm-hmm.
You got to be there to collect or mail, pick up the mail. You got to chase them down if they're not paying. You know, you may miss a month. Oh, I forgot to contact the tenant about their late rent. You know, or same thing with you know, when they get to the point where. Another thing I like about self-storage is that it's very landlord friendly because there is no landlord. It's just stuff. Someone stops paying, there's no eviction process. It's literally just whatever the state's lien laws are. If they stop paying, you basically pull their access code if there's a gate, and you stick an overlock over the top of the self-storage unit until they pay you back. And if they don't pay you back, and it can be anywhere from 15 to 90 days, whatever the state allows you to do. If they don't do it, you cut the lock and you auction it off. Now you're not going to make a lot of money off that auction, but that's how, you know, that's how you get them out of your place. And then you sweep it out and rent it out to somebody else.
That's great. That's great. I'm sure a lot of people have seen Storage Wars, and that sounds familiar to.
Yeah.
That's exactly what that is.
Yeah. And it's really just about finding, there's so many opportunities in self-storage to add value.
Mm-hmm.
You know, you can buy a facility that is that has room to expand. They just haven't used all their land. You can buy a facility that doesn't have, has no climate control. You can add climate control buildings. You could have a facility that's got RV storage that's, you know, 30% occupied when their under roof storage is 100% occupied. And you can kick out the RV people because there's clearly not a demand in the market, and you can build storage units. You can, you know, you can raise rents. Sometimes these mom and pop operators will leave their rents the same for 10 years. And, you know, you'll ask them, you know, what's your occupancy like? Oh, we're 100% occupied. Just like being occupied. Have you raised your rents? No, I like being occupied. Well, what they're missing there is a concept called revenue management, not occupancy management. Because if you're 100% occupied, your rents should be going up.
Yeah.
Because the demand is there. And, you know, and you can raise rents. You know, the average self-storage operator, when they're doing it right, raises rents about every 9 months.
Okay.
Because there's no lease. It's month to month.
Yeah. Yeah. And
anyway, the short answer is that there's a lot of opportunity out there. There's a lot of small markets, small operators that are out there, and depending on their life situation, what's going on, they'll probably be looking to sell.
Yeah. And I also, just like as you touched on earlier, it's about the demand as well. There always seems to be a demand for self-storage, you know, like either people have too much stuff or they're downsizing and they need somewhere to store their stuff. There always seems to be a demand for that. As long as there's a demand, you know, you always have a good business that way.
And that's a very important point. It's a supply and demand asset.
Mm-hmm.
And it can be very, very market specific. The industry average that's considered market equilibrium is about 7.5 square feet per capita, meaning that there's 7.5 square feet for every person living within a certain radius of that property. It's usually 1, 3, and 5 miles. So within 5 miles. But that's a very national average. There are some markets that, you know, in Las Vegas, for instance, we are at, I think, 11.5 square feet per capita.
Mm-hmm.
But Las Vegas is still building new self-storage facilities, and most of the facilities I know are pretty full, and they're raising rates because Las Vegas is a very transitory market. There's you know, there's a lot of people that have small garages, they've got toys, whatever. I mean, whatever, for whatever reason, there's just a very specific market factor that makes self-storage demand higher. Whereas you may go into another community where there's only 4 square feet per capita, which would say you would think would mean they're undersupplied, that they need more storage square footage. But you got to go into those individual markets and start talking to those storage facilities in that area. And if they're not 100% occupied, then there's probably not a demand there.
Mm.
But if you're going into an area where every facility you call is 100% occupied, and you find a facility that is, even if they're mostly occupied, but they're under rent and they don't have a website, they don't have, they don't have online check, they don't have online rental, they don't have, because chances are that the market is saying that there's demand there and they're not meeting the demand in a way that is efficient. And you can go in and basically improve that property, even without expanding. You just basically go in and you build a website,
Yeah.
Make it so they can rent online on their phone, advertise on Google AdWords so that when somebody searches for storage in that area, it comes up. It's such things that you would think are such no-brainers, but a lot of these old mom and pops, they're not very technologically savvy. They've been doing it for years. It works fine. They make plenty of money. They don't really care. So
yeah, I think it comes down to, just like you mentioned earlier, treating it like a business rather than just something you buy and kind of almost forget about. I think that it's similar to multifamily in that way, in that a lot of times that's where the opportunity is, when someone hasn't really treated it like a business. They've kept the rents the same. They've not really taking care of the expenses, but they bought it cheap enough and long enough ago where they're just making enough money that it doesn't really matter. That money's coming in. They don't want to raise rents. They're not worried about lowering expenses, and they can just get that money every month.
Yep.
Cool. Well, thank you for sharing that. I think anyone who didn't know about self-storage in terms of an investment strategy, I think you shined a light on that for sure. So I definitely learned during that. So thank you for sharing that. Even
if anybody wants, can I pitch something here?
Of course.
So, I do a 30-minute call, free 30-minute call with people every week. I have, somebody sign up and we just get on and talk about real estate. We switched over that. It was really great, but we switched over to now we just talk about storage. So if anybody is interested in self-storage, or if you are a self-storage owner, we love talking to self-storage owners. Go to roadtofamilyfreedom.com/self-storage call, and you can sign up for a call there with me. There's no obligation. There's no coaching program. There's nothing. It's literally just, I'm a working dad. So my free time is limited. This is sort of my way of getting out of networking. And it's just fun to, I'm a real estate nerd and I love to get on calls and talk to people about real estate. So I highly, please sign up.
Yeah, I recommend anyone who has an interest or who is in self-storage does the same. So we'll put a link in the notes or in the description, so anyone who wants that can do that. Thank you so much for sharing so much today, the highs and the lows. It's been a great talk. Is there anything that we didn't cover that you wanted to cover, or anything that we didn't talk about?
Not really. I think we,
we covered a good amount. Yeah.
Yeah. A long and winding road.
Yeah, absolutely. And it's continuing, right? It's just that never ending journey. That's the fun of it, I think. So for anyone, give your podcast a plug again, and anyone who's trying to reach you, how they would reach you.
Yeah, we've got the Road to Family Freedom. My lovely wife and I co-host it most of the time. She hasn't been available the last couple of episodes because she's just had a lot going on. But normally my lovely wife is there with me, and we teach busy families how to achieve financial and location independence with real estate. And we interview a lot of really amazing, successful people. So check us out there. If you want to reach me, the best way is probably to go to info@roadtofamilyfreedom.com.
Cool. And you guys have an Instagram as well, right?
Yep. Road to Family Freedom on Instagram.
Yeah, you do a fantastic job of that social media. So, yeah, as always, it's been fantastic talking to you. Thank you for taking the time. And we've got a lot going on right now, but I really appreciate you taking the time. It's been a lot of fun hearing your stories and what's been going on with you. So thank you very much. And anyone, again, it's called Road to Family Freedom. It's a fantastic podcast, and same on social media. So thank you, Neil.
Thanks, Barry.
Thank you.